Welcome to another tutorial video. This time around, we're going to be going through a bank stock pitch. So you might use this pitch if you are interviewing with a financial institutions group, or FIG as it's sometimes known, or a financial institutions or financial services focused private equity fund or a hedge fund or anything else like that. Now, as with some of the other stock pitches that we've covered here, you really need the written documents and the Excel files to get the most out of this tutorial. So if you go to mergersandinquisitions.com and type in /bank-stock-pitch, you will be able to get everything there. I will also post a link to that in the description of this video at the bottom. But as with many of the other stock pitches, you really need to actually see the pitch and the accompanying Excel file and valuation and all that to get a whole lot out of this. So I strongly recommend going here first, mergersandinquisitions.com /bank-stock-pitch. So we're going to cover 5 main topics in this lesson. First off, I'm going to tell you a little bit about the story of this company, Shawbrook, and its industry, commercial banks more broadly, but more specifically, the challenger banks in the UK. Then I'm going to go through the structure of this pitch and the different operational and valuation scenarios we came up with to create it. Then I'm going to tell you a little bit about some of the challenges with the financial model here. This is quite a complicated financial model. We have a lot of tabs. This model took us over a month to create, so it's not really something that you could just do in a weekend or a single day or something like that. It's much more representative of something that you'd actually build on the job as opposed to something you do in a time pressure case study. However, some of the issues that did come up here may come up in your own case studies and stock pitches, so I want to address some of that here. Then in part 4, I'm going to walk you through how we actually made an investment decision in this case, and then how we thought about the catalysts and the risk factors associated with it. And then in part 5, I'm going to tell you about why this recommendation was correct. As you can see from the image here, in some cases, your recommendation ends up being correct, but not for the reasons that you originally anticipated. And in this case, since we're dealing with a UK-based bank, the Brexit vote in June of 2016 in the UK had a lot to do with the stock price here going in the direction that we predicted. So let's go into part 1 first and talk a little bit about this company and the industry as a whole. In the aftermath of the 2008 to 2009 financial crisis, the big banks worldwide suffered quite a bit because new regulations like Basel III and CRD4 in Europe made it a whole lot more complicated and expensive to operate as big banks. So these institutions, the bulge bracket banks in the US and Europe, and in general, the large diversified banks worldwide became a whole lot less lucrative as businesses. They also had to hold a lot more capital, in other words, common shareholders' equity, to run their businesses because these regulations like Basel III and CRD4 required them to hold more equity to be in compliance with all the ratios and regulations. So as a result, of course, banks cut costs, they started spinning off divisions, and they also commoditized many of their products. So they no longer wanted to spend as much time customizing loan products and advisory services and other things like that to specific clients. They wanted to cut costs as much as possible and commoditize many of these products and make everything the same. This created a market opportunity because many segments were now underserved by the large banks, so smaller competitor banks started popping up to attempt to serve these segments more effectively. And in the UK, challenger banks arose, and they started serving segments like buy-to-let mortgages. In other words, mortgages that were taken out for homes that you were not planning to live in, but a home that you were planning to rent out to someone else. And then also small and mid-sized enterprise lending, asset finance, other segments like that that the bigger banks couldn't serve as effectively. In a lot of cases, these loans require more customer service and more customization. It's not as simple as just entering a formula into a computer and then getting a result right away, which is pretty much what the banks do in a lot of these cases. These require a lot more human intervention and oversight, and they tend to be less profitable than some of the more generic loans and services that the big banks provide. As a result, the larger banks, the high street banks in the UK especially, did not focus too much on these segments. Now, Shawbrook you could call the poster child of the challenger banks. As of the time of this case study in the prior year, the company had recorded 70% loan growth, which is astoundingly high, far higher than all the large banks, which probably have loan growths of 5%, 10%, something in that range. Shawbrook was growing at a much faster rate than the larger banks. And same with the other challenger banks. One Savings, Aldermore, other newer firms like that had just started up were all recording very, very high growth rates. Of course, with valuation, the question is not what a company's historical growth rate has been, but what its expected future growth rate will be and whether or not that justifies the bank's valuation. For a commercial bank, the growth depends on the growth of the overall economy or the GDP in the country that it's based in, the bank's market share, and then the yield that it's getting on its loans. So if the economy is growing more quickly and the bank's market share is staying about the same, its yields on loans are staying about the same, the bank will still do pretty well because the economy as a whole is growing quickly. Now, if the economy is staying about the same, but the bank is gaining more market share, its yields are staying about the same, it'll also do well because its loan balance will keep increasing. Loans as a whole are not going to grow that much if the economy is stagnant, but if the bank keeps taking market share, its own loan balance will keep growing. So the bull case for Shawbrook is that the UK economy continues to perform well. The company keeps gaining market share. It's gained a lot since it started up. And then it maintains its above average loan yields despite more competition. And it can start issuing dividends in another year or two and then eventually increase those dividends over time. The bear case is that the UK economy stagnates or enters a recession. The bank's market share gains slow down. And then its yields also fall as a result of increased competition and other banks charging less. Dividend growth is also lower than expected. Maybe the bank can start issuing dividends in a few years, but growth rates on those dividends will be lower than what the market as a whole expects. So our job in the stock pitch is to decide which of these views is correct, or to decide if maybe something else is correct and something that's not expressed here is what will actually happen. And then once we have that, we figure out what the company should actually be worth based on those assumptions and whether we could make money by longing or shorting the stock. In other words, betting that it's going to go higher or lower within the next 12 months. So let's go into part 2 now and talk about the structure and scenarios here. We always recommend the same structure for stock pitches regardless of the industry or geography or anything like that. Normally, you want to start with a high-level recommendation and give the 3 main reasons why the company is mispriced, what will change its stock price, and then explain if you're wrong, how you might hedge against that risk of being wrong. So in our stock pitch here, we have around a page or so in the beginning, about a page and a half with the overall recommendation. And we state up front that we think the company is overvalued by 30 to 50%. We think there are 3 to 4 catalysts, specific events that will change its share price in the next 12 months. And we think the market's views on the company's growth rates, its asset yields, its risk weightings, and a number of other things are all mistaken. So we're stating our reasons right up front in the beginning, which is exactly what you want to do here. Then in the next section, you can go into the company background and talk about the industry, the financials, the relevant multiples for them. So here we have a breakout of the company's loans, and then we give some information about the multiples. This section is not terribly important because it's all information you can easily find online or anywhere else. The investment thesis is where you expand on the 3 main reasons why the company is mispriced. And so we give our 3 main reasons here. Number 1, we expect a general slowdown in the UK economy and in the housing market as well. We expect more competition to push down interest spreads. And then we also expect the company's long-term return on equity or return on tangible common equity to be lower than expected. And then we go into a lot of detail on why we think that way, the different scenarios we come up with, and so on and so forth. In the catalyst section, you have to talk about the specific events that might drive a company's stock price higher or lower. And in this section, we do that. We paste in a lot of tables and we try to quantify everything that we're saying. And so we say, if loan yields fall by 1% or 2%, the company's share price is worth 10% less or 15% less or something like that. In the valuation section, for a bank, just like a DCF analysis is one of the most important methodologies for normal companies, the dividend discount model takes the role of a DCF for commercial banks. So we do have comparable public companies and the relevant multiples there. We also have precedent transactions, but the dividend discount model is really the most important thing here. It's a little bit hard to see on this page, but you can take a look at the Excel file and you can take a look at some of the conclusions that we paste in. Basically, the dividend discount model in most of our scenarios seems to indicate that the company was overvalued at this point in time. And then finally, the risk factors, you want to admit that you could be wrong. So in this case, for example, we take a look at the main catalysts that we mentioned. We reverse them and say, well, maybe the risk weightings on mortgages won't change. Maybe the mortgage market will grow more quickly or as quickly as expected. Maybe loan interest spreads will stay the same or increase. And maybe funding costs will decrease or stay about the same. And we go through each of these and point out why, even though it is possible, we don't find any of these particularly likely and what we could do to hedge against it in the worst case scenario. So that's the same structure you always use. I just wanted to point out how some of these points apply specifically to banks. With commercial banks, when you're creating any type of valuation or stock pitch, it's very important to look at scenarios because the key drivers and assumptions like GDP growth and interest rates are all interrelated. It's not like a pharmaceutical company where the drug price could double and the company's expense profile could stay the same, or where a drug patent could expire and then everything associated with revenue for that drug changes as a result. With banks, for example, you can be almost certain that if GDP growth falls and there's a recession, central banks are going to drop interest rates. If GDP growth rises and they start getting worried about inflation, then central banks are going to probably increase interest rates. So we created a base case, an upside case, and a downside case. The basic difference is that the upside case has the highest interest rates, the highest GDP growth, the highest market share growth, and then the lowest charge-offs and provisions that cover the potential defaults on the company's loans. The downside case has the lowest interest rates, the lowest GDP growth, the lowest market share growth, and the highest charge-offs and provisions. Just to give you a flavor of this, if you go to the loans tab in this file, you can see right here that if you look at the nominal GDP growth rates and the different scenarios, we're about in the middle in the base case. The upside case is much higher. And then in the downside case, we have a recession followed by a recovery in the last 2 years. We don't change anything with the size of the lending markets here by segment. We're just assuming these are some percentage of nominal GDP in the UK. What does change, though, is the company's market share. And you can see that once again, in the base case, we're sort of in the middle with market share. The upside case is higher and the downside case is lower. And we do that across a number of these scenarios. I'm not going to go through everything. This is just intended to give you a flavor of what you might change and how these assumptions are all interrelated for commercial banks. In the dividend discount model, we actually create 15-year projections here. We need to do that because the company is not even issuing dividends right now. So we need to go out a bit further into the future than we would for a normal company or a more mature bank. What that means is that we need assumptions for the long-term return on tangible common equity, and then also for the long-term asset growth. Now, the basic approach here is not too complicated. We simply look at both of these numbers. I have the base case open here. So the base case, the company ends up with a return on tangible common equity of around 17 or 18%. And then we go up and we just gradually make these decrease over time. So in the base case, it goes down from 16% to 12.5% over the span of about 7 years. Actually, more than that, because we're looking at 7 years beyond the end of our projection period. And eventually, we end up at this 12.5% number. The upside case goes to a number that's a little bit above that, and then the downside case is slightly below that in the end, and the same goes for total asset growth. Now, if you're wondering how exactly we got to these figures, if you look at many of the comparable companies, and especially banks like Paragon and Virgin Money that have been around for longer, we looked at these as the more mature challenger banks and said that if they have return on tangible common equity figures of around 12 or 13%, chances are when Shawbrook is older and is around a decade or 15 years old, it is probably going to have a return on tangible common equity in about the same range. Let's go into part 3 and talk a little bit about some of the challenges that came up here. Now, as I said, this is a very complicated model, and we don't have time to get into every nuance. The whole walkthrough in the course is about 15 or 20 hours long, so we're just giving a very high-level summary here. But just to show you an example, one key problem that came up was how to calculate cost of equity. And the problem is that the traditional approach, which you use in a dividend discount model, and also when you're using cost of equity for a WACC and a DCF, just doesn't work. Normally, you take the risk-free rate, and then you add levered beta times the equity risk premium. But take a look at what happens in our Excel file if we try to do that here. We get results like 1.9% or 3.1%. And then even if we use the dividend growth rate method, we get 55%. So clearly neither of these results makes much sense. So our solution instead was to expand the set of comps and look at larger banks that are based in the UK, which explains this set of companies like HSBC and Lloyds and Barclays, for example. We got to cost of equity around 10, 11, 12% like that. And then we also looked at non-challenger banks, which include some of these large banks and also some smaller banks that have been around for more time. And this gives us results of around 10 or 11%. So we have to approach it in a slightly different way for a bank like this. The problem is that all the companies' comparables have limited trading histories and very high dividend growth rates. Some of these companies don't even have a figure for 1-year beta because they just went public very recently as of the time of this case study. And then pretty much none of them have anything for 5-year beta because they just haven't been public companies for long enough. So we had to take a somewhat different approach. And as I said, we just expanded the set of comps and looked at cost of equity for a wider set of banks. Also, in the dividend discount model, we took a slightly different approach to the cost of equity than what you normally see in a lot of banking style analyses. Often investment banks, when analyzing companies, will use the same weighted average cost of capital or the same cost of equity figure throughout all years of the projection period. The problem is with a company like Shawbrook, it's changing a lot over these 10 or 15 years. So we started off at a relatively high figure, 12%, and then over time, we scaled it down to 11%, which is still on the high side. We wanted to be conservative, but we did decrease it over time to represent the fact that the company gets bigger and more diverse and less risky over time. Now, you might look at this and also be wondering how we can possibly create a dividend discount model if the bank doesn't yet issue dividends. But the short answer is it doesn't really matter. It's true that they're not currently issuing dividends. However, they do plan to start issuing dividends within the next year as of the time we did this stock pitch and case study. And so as long as they start issuing dividends at some point in the future, the dividend discount model still works. So that's not really an issue at all. It's sort of like how if you have a pharmaceutical or biotech company, they may not be making any money right now, but as long as they start selling that drug in the future and you project out far enough to get to that stage, you will be able to still use some type of DCF analysis. It may not be quite as valid as it is for normal established companies, but you can still create something there. Now let's go into part 4 and talk about how to make an investment decision using this model and valuation. The end result from all this is a pretty classic asymmetric risk profile. So I just have the base case up here on screen, and you can see that the company's share price at this time was around £3 and 20 pence or 30 pence or something like that. So just looking at the graph, it's pretty obvious that the dividend discount model, the residual income model, and even the medians for the comparable public companies indicate that the company is probably overvalued. And if you go and change the scenario here, and let's say we go over and we change it to the downside or upside case, we get these results. In the downside case, the company's overvalued by about 50%. In the base case, it's overvalued by about 30%. And in the upside case, it's undervalued by about 30%. So if you think about what this means, we have potential gains of 50%, but potential losses of only 30%, which is exactly what you want to see when you make this type of recommendation. Now, you could probability weight these scenarios and say there's a 1/3 chance of the downside case, 1/3 of the base case, and 1/3 of the upside case. We don't think that's terribly useful. We think it's actually better just to keep it more high level like this and not to multiply by probabilities. Our gut feeling, for a number of reasons, is that something between the base case and the downside case is most likely. We don't necessarily think the UK is going to go into a recession, but we also think there's a decent chance that the GDP growth will probably not be 2% or 2.5%. It might be a bit lower than that over the next 5 years. So once you know which direction you're leaning, which is pretty easy to tell in this case, you have to substantiate the pitch with catalysts, because the company's share price could stay at the wrong level. The company could be mispriced for many years if no events come along to change its stock price. So for banks, the potential catalysts could include changes to their loan and deposit ratio, acquisitions, divestitures, regulatory capital changes, changes in dividend policy, more provisioning for bad loans, more defaults and charge-offs. There's a wide set of potential catalysts, but the three that we picked here are: number one, we think the risk weightings on many of the company's mortgages will change. As a result, they'll probably have to hold more capital. We think their loans will grow more slowly than expected because we think there's going to be lower than expected economic growth. Home sales in the UK are going to be down. And we think the changed stamp duties and some of the tax treatment of mortgages is also going to affect this home market and result in fewer mortgage originations. And then finally, we also think that interest spreads on loans will compress because of increased competition. Shawbrook already charged more at this point in time than many of its competitors on the same types of loans. We don't think they have a strong, sustained competitive advantage that explains why they can do that. So we think that yields are going to fall and interest spreads are going to fall. Now, in terms of the risk factors, you want to reverse the catalyst and think about what happens if they don't transpire as you expect. So here we went to the upside case in this model, and then we made things even more optimistic. And we said, okay, let's take these upside case scenarios and then assume that we get more of a perfect storm scenario, and found that realistically the company might be undervalued by 50% if we're really completely wrong about everything. The bank performs better than expected, and economic growth and everything else is much better than we expect. To hedge against that risk and this worst case scenario, we recommend buying call options with an exercise price about 20% above the company's current share price. We could also long competitors that are more focused on mortgages, just in case we're completely wrong about that market in the UK and it does actually pick up or the growth actually exceeds expectations. The basic logic is that if our potential gain is anywhere from 30% to 50%, we don't want to lose 30 to 50%. We want to limit ourselves to more like a 20% loss. And so that's why we recommend call options with an exercise price in that range. And again, if you look at the whole detailed stock pitch, we go into this and we look at the worst case scenario toward the end, and we give some specific recommendations on the call options or a buy stop order or ways to long the sector as a whole or other banks that are competitors of Shawbrook. And then finally, in part 5, I want to tell you a little bit about why this recommendation was correct. The way I'd summarize it is that we were right, but for the wrong reasons, or maybe that we were right, but for slightly different reasons than what we expected. So here's a graph of the company's stock price between when we made the recommendation in the pitch in September 2015 and September 2016. Now, the stock price did generally decline from the time we made the pitch to just before the Brexit vote in June of 2016. So in that sense, our recommendation was correct. You would have gotten probably around a 10% gain if you had taken our advice and shorted this company's stock. But as you can see, right when Brexit happened, the company's stock price fell off a cliff. It dropped by, looks like around 50% from this graph, if not more than that. Now it's gradually recovered since then, but Brexit is what turned this recommendation from moderately correct into almost an exact match in terms of what we recommended. Now, it doesn't mean our analysis or our approach were invalid. The point here is just that you can have the best analysis and valuation and all that in the world, but if something unexpected comes along, then perhaps market sentiment will change in the way you expect, but not for the exact reasons that you expect. And that is the point of this. We're at the end, so let's do a quick recap and summary. In part 1, I told you the story of this company, Shawbrook, and its industry challenger banks. They came up to attack some underserved market segments in the UK that the large banks had been ignoring as a result of cost cutting and changes following the financial crisis. The structure in the scenarios here were as follows. We created a base case, an upside case, and a downside case, and carried them all the way through our valuation and operating model. And then we use the same basic structure for our stock pitch that we always do, and came up with some reasons why the company might be mispriced, thought about the catalysts, the risk factors, and so on. With the financial modeling side of this, there are many challenges, but just one example is how difficult it is to estimate cost of equity for a relatively new public bank like this. Then in part 4, we talked about how to make an investment decision. In this case, it was pretty simple because we saw that the company was potentially overvalued by up to 50%, but potentially undervalued by only around 30%. So we have an asymmetric risk profile and the opportunity to make money. We came up with some catalysts, such as the mortgage market growing more slowly than expected, risk weightings changing, and that changing the company's regulatory capital, a couple others. Then we reversed them for the risk factors and made some recommendations for how we could hedge ourselves with call options or by longing other company stocks. And then finally, I explained why this recommendation was correct. It was correct even before the Brexit vote, but that vote and decision made it match up pretty closely to what we predicted in our stock pitch and in our recommendation. So that's it for this tutorial. Hopefully you know a little bit more about how to analyze banks and make stock pitches and recommendations for banks, and how you can apply the same basic framework to any industry out there, even commercial banks and financial institutions.